Have you ever wondered why some investments promise potentially huge returns while others seem much safer but offer less? It is a bit like choosing between a high-speed roller coaster and a gentle Ferris wheel, where your appetite for thrills dictates your ride. Risk profoundly affects capital allocation choices by acting as the fundamental driver behind expected returns. Investors consistently demand greater compensation or a higher return for taking on higher levels of uncertainty with their capital. The core principle guiding this is the risk-return trade-off. Every investor, whether consciously or not, grapples with this balance. Risk is essentially the possibility that the actual return on an investment will differ from its expected return. Economists and financial analysts categorize risk broadly into two types: systematic risk and unsystematic risk. Systematic risk, often called market risk, affects the entire market and cannot be diversified away, meaning it impacts all investments to some degree. Unsystematic risk, also known as specific risk, is unique to a particular company or industry and can be reduced through strategic diversification. Investors are generally considered risk-averse, meaning they prefer lower risk for a given level of return, or conversely, a higher return for a given level of risk. This inherent aversion leads directly to the concept of a risk premium, which is the extra return an investor expects for holding a risky asset compared to the return on a risk-free asset, such as a short-term government bond. The risk-free rate serves as the baseline, and any investment above that must offer a compelling risk premium to attract capital. To effectively make these allocation choices, investors typically perform a thorough risk assessment, carefully considering their own personal risk tolerance, their financial objectives, and their investment horizons. Following this assessment, they engage in asset allocation, which is the strategic distribution of their capital across various asset classes like stocks, bonds, real estate, and commodities. This distribution is precisely calibrated based on their established risk profile. Diversification, a key strategy, involves spreading investments across different types of assets to mitigate unsystematic risk. This thoughtful process helps align their investment portfolio with their comfort level for market volatility and their specific long-term financial goals. Advanced capital allocation often employs principles derived from modern portfolio theory, also known as MPT. MPT suggests that investors can construct an efficient frontier of portfolios. These portfolios are optimized to offer the highest expected return for a defined level of risk, or conversely, the lowest possible risk for a given expected return. Understanding the various correlations between assets is crucial here, as combining assets that do not move perfectly in sync can reduce overall portfolio risk without necessarily sacrificing returns. This sophisticated approach moves beyond simply picking individual securities and focuses on the interplay of an entire portfolio. Ultimately, recognizing and meticulously managing risk is absolutely central to achieving your financial objectives. By understanding the inherent relationship between risk and expected return, and by applying strategies like diversification and strategic asset allocation, investors can make more informed decisions. This allows them to effectively balance the potential for capital appreciation with the crucial need to mitigate potential losses, ensuring a more stable and goal-oriented investment journey.